Hello again. This is Leanne Casavoy with Civitas Strategies. I am here with Gary Romano, our president and CEO, and this is our combined July and August issue of our reader questions from the Taking Care of Business blog. So here we go. I'm going to ask you the first question, Gary, and you will probably agree this is the most common question we get asked, especially this time of year. What are the standard meal allowance rates for 2023?
It is a very common question. So, as many of you know, every year the USDA comes out with the official food rates. They just came out a couple of weeks ago. We're going to post them on the site so you'll be able to see them. Just remember a couple of things with it. So, first of all, the Keep Kids Fed Act, I don't know why I'm having problems with that, like sequence. That expired in June 2023. That was that additional money that many of you know, that differential that you were getting during the pandemic, where you're getting an extra 10 cents or so per meal. So that law has expired. So you won't see those supplementals anymore. You're not going crazy. They're not there anymore. The other thing to keep in mind is that the reimbursement rates for your taxes, because I know many of you want to use the standard rate on your taxes, which is a great idea. And we could talk about that all day, right? But it's a really good way to do it, that tier one rate. The one that you use for your taxes is the rates that were in effect on the first day of the tax year. So the ones that just came out are technically 23 to 24. Those will be used next year's taxes. For the taxes for 2023, you're still using the 2022-23 rates. So just know, because I know that then confuses people later on. They say, are these the rates for the taxes? Well, they are, but not for this tax year. So just keep that in mind.
Okay. Our next question is related. If I have two children who are in my house, but who are not my biological children, can I claim them on my food program? I have been told that I cannot claim them because of my income.
So basically, if they're not eligible, and your household is not eligible, then they would not be eligible. In terms of the question around dependency, like if the household was eligible, then you get into a question of dependency, which is a different one. But if you're not eligible, the kids are not eligible.
Okay, perfect. Our next two questions I'm going to ask at the same time because they are very similar. So here's the first one. I am retiring from daycare next month. I want to replace my flooring and carpet later this year to restore it to what it was before daycare started 17 years ago. Is this deductible to restore what it was, even though I'll no longer be in business? And then the second question, I've been running my home daycare in this house for 10 years, but I have been in business for 30. The living room where the kids nap and the playroom were in dire need of repainting. The paint was worn and peeling off. Also, there are several broken slats on the blinds, so they needed replacing. Can I write this off as repairs or maintenance for my daycare?
So the simple answer is yes, to both questions, right? It would be deductible in the same way any other business expense would be deductible for you. So remember all the things we've talked about with your time space calculation and exclusive use versus regular use. You're going to want to keep those in mind to temper how big a deduction it is and whether it's a deduction at all, right? Because if you did have, a room that you redid and it's not used at all, like let's say your primary bedroom, a lot of people don't use it at all, which is totally understandable. For the childcare business, then of course the costs in that room would not be eligible. So yes, you can pursue them, but pursue them in the same way you would any other deduction with your home.
And the provider who is going out of business, that doesn't matter, that as long as it's in this tax year, it's deductible?
That's right.
Perfect. Okay. Now we have two more related questions that are together. First one, if I provided care to a family and they did not pay for that care, can I then deduct it on my taxes if I provide proof that their child was in my care during that time? And then similar question, if I have a parent with a past due balance of over $9,000 but under $10,000, is there a way to legally collect the money? This provider is located in Minnesota and said, I plan on terminating care for this reason, but I want to have my ducks in a row first.
Absolutely. I mean, great questions, right? So let's take each one of them first, because I think it can be a little bit confusing as
Mhm.
to why I'm going to say one has this path and the other one doesn't, which is why we wanted to bundle these, right? So in terms of the first question, did the family did not pay for care? Can I deduct it on my taxes? So you really can't. And the way deductions work is that you have to have revenue and an expense, and they have to be able to match. In this case, you didn't get revenue off of it. You may have
Mhm.
an expense. I don't disagree with that. And you're, able to deduct your overall costs and stuff, but the revenue was never realized. So you can't pretend that the revenue was ever really there and it was lost. It just was never there at all. And you still get this expense to deduct, but you can't then additionally deduct revenue that didn't come in. Now, what's a little unclear is if you're in the same boat as our second reader, watcher, whatever. That sounds
Let's
creepy. Reader. Let's go with the reader.
go with reader.
Um, yeah. So in this case, you've issued a bill, it sounds like, right? You probably, I hope, have something in your parent handbook and in the agreement about how they have to pay their past due
Mhm.
bills and what that timing is, right? So in this case, you have somewhere between 9,000 and 10,000 that's owed to you. Um, in that example, you could pursue them in court, likely small claims court, depending on your municipality, um, for not paying that bill. Additionally, you could theoretically write it off as a bad debt. There's a whole process for doing that. Um, but I would suggest that you seek legal counsel around that, because even if you pursue small claims court by yourself, it can be costly in terms of time, in terms of actual dollars that you're putting out. And so you're going to want to talk to legal counsel to really understand in your area what are the probabilities of your winning that case and what you would win, so you wouldn't go and put out more than the $10,000. And
Mm-hmm.
again, in that first case, if you have invoice them and such, then theoretically there would be the opportunity to do that as well. It doesn't sound in that case like there's a large amount of money that's past due. So that may not be worth it even if you have.
And when you say bad debt, can you explain what that is in terms of a deduction?
Yeah, so there's a whole process for declaring when somebody who owes you money has not paid you. And what would
Hmm.
ultimately happen is, in this case, actually, you wouldn't be able to use it as bad debt because you haven't given them any money, right? Again, it's similar issue to the first one. So in this
Okay.
case, it would just be small claims court. So I misspoke there.
Okay, so bad
Yeah,
debt would be
yeah.
if you paid out money to someone and they
Yeah,
didn't
so
pay
if
you
I
back.
gave you a loan, Leanne, and you didn't pay it back, then I could theoretically pursue it as bad debt. It
Okay.
becomes a deduction to me. The principal would be deductible. Potentially, you would also get a notice from me in the form of a 1099, then making that debt, which is normally not taxable, would be
Hmm.
taxable. But in a
Okay.
case like this, there is no debt.
Okay,
So
that makes sense.
yeah, I misspoke there.
No, thank you for clarifying. Okay. All right. Next question. I run a childcare in my home. In 2022, I received a COVID grant for $13,000 that was specifically for replacing the flooring in my home from carpet and switching it out to something that was easily cleaned and sanitized. I used the grant money to pay for the flooring and to pay the installers. I guess I assumed this would be a wash. But my accountant said since it is in my home and we use it outside of business hours, that the amount of the flooring and the installation has to be depreciated. So this money was counted as income. I am a single parent and am on Medicaid. This extra income will now make me ineligible. I am not sure why it can't be deducted, or at least a portion of it. This is going to cost me more than I ended up getting. Is my accountant correct, or am I able to deduct a portion of this?
So, in this case, it's a little bit difficult because we're lacking some key details. But let me fill in some of the gaps on what I think is likely,
Hmm.
right? On what's happening here. And, certainly, reader, I'll say viewer, if I'm missing it, please don't hesitate. Let us know, reach out to us, we'll clarify it. But it sounds like what we're talking about is COVID relief funds. So you may have heard it called stabilization or stimulus for childcare.
Hmm.
And those relief funds at a most basic level on your taxes are treated as revenue, right? Just like any other revenue. Now, you have an expense. in this case, the replacement of flooring. And, what I'm hearing and I think is happening is that you paid for the flooring, let's say it's $10,000, and now your accountant is saying, gosh, Leanne, you have to apply time space to it because this is not an exclusive use room. Just as we were talking about time space earlier, that can be a little bit of a surprise, right? So if, let's say, we have the example of you had a $13,000 grant, right? Let's make it a little bit, an odd number, and you have time space of 75%. In that case, you would say, oh, Gary, I got 13,000. I spent 13,000 on the floor. That's a wash, just like you said. However, you're still subject to time space. If this is a regular use area, so we have to only deduct 75%, which is $9,750. The other $3,250 would be considered a personal expense. So that would not be deductible against the business. That's taxable, right? So that would mean, and that's what I think is happening in this case, is that when your CPA or your tax preparer applied time space, you went from here to here, where suddenly there was a differential.
Mm-hmm.
The other challenge, and this is an important one to know as you're thinking about this tax year. Since we're talking about 2022, unfortunately, all your options are closed at this point. There's nothing extra you could do to change that. Now, what you may want to do is what I always recommend is when you're getting your taxes prepared, look through every one of your bills, personal and business, look through every one of your credit cards, personal and business, make sure you didn't miss any deductions, right? Max out that home deduction. Make sure you're getting all those deductions. That's about the best you can do. But unfortunately, it's not like I could say, okay, reader, go and put a little bit of money into, a 401k or a SEP or something like that, and that'll come down as a deduction. Unfortunately, at this point, the year is closed, but look for anything you can scrounge to bring that number down, because I do hear what you're saying. And we've seen this a fair amount over the past 2 years, and I'm sure we're going to see it this year too, where people got surprised when time space hit. They got surprised at the difference, and it's impacting them on their taxes, but it's also impacting them, as you said, on eligibility for social programs. We've seen it impact folks whose kids are in college, right? This is real. So it's a good time to take a hard look at your revenue and your expenses from this year and see, are you doing better? Are you doing worse? Are you putting aside enough tax money? Is the bill going to be bigger this year? So make sure you get ahead of that.
Can you also speak about depreciation a little bit in relation to that one? So if the time space came out to $9,750, would she then have to depreciate that, or does that not qualify?
And that's a great point. And this is where, we don't have a whole lot of information on the flooring and the nature of the work, right? There is a chance you would have to depreciate it. And to your point, Leanne, I mean, this is what compounds the challenges that people see end of year since we've had the stabilization funding. It's been wonderful, right? And you all are doing a great job staying open, helping kids. And so I know it's well deserved. The challenge is one on the taxes and how you get surprised at the end of the year. So what Leanne's describing is, look, we already have time space as a mismatch. Well, now if we have to depreciate it over a number of years, the amount you could deduct this year becomes even lower. And we've seen this. We've seen this with decks, with roofs that have gotten redone. So yes, it could be a compounding factor. We don't have it's hard to make a firm recommendation in this case, but yes, if she has to depreciate it, then it's going to be even lower, which means her tax bill will be even higher, and she'll have those impacts to her benefits in an even bigger way.
And we will put links to the depreciation guide in the text with this video, because I know that is a confusing subject that people often have questions about. All right, we are on to our last question, Gary. If you paid your child $12,000, would you no longer be able to claim them as a dependent?
So, as long as they meet the other criteria for meeting a dependent, likely you would be, right? And so one, are they related to you? There's a whole litany. right? People who are dependent, son, daughter, stepchild, eligible foster child, etc. Do they meet the age requirements? Are they under 19? They're a full-time student. They can be up to 24.
Hmm.
Do they live with you? Right? Typically, they have to live with you more than half the year. Of course, an exception is if they're away for that college. That's
Hmm.
okay, right? But otherwise, like for example, if you're sharing custody with a former spouse or significant other, right? The question would be, are they with you more than half the year? Do you financially support them? So your child can have a job and still remain as your dependent, but they can't provide more than half of their own support. Now, in this case, the 12,000 in and of itself is likely hitting that number, right? Probably putting more into that. I know I'm putting more in my kids, it feels like. So, likely that's, not is less than half their support. However, you have to keep in mind, like if they have a second job, if there's some other,
Yeah.
maybe some relative left them some money and there's a little bit of investment income coming in. Doesn't have to be a large amount, but then when we start adding these things in, that could be a problem. So definitely pay attention to those numbers. On the surface, it doesn't sound like a big deal, so don't panic, but
Hmm.
just make sure, as our previous reader said, you have all your ducks in a row.
Exactly. And we have some information on hiring children, which a lot of people do without issue. So we will make sure we put those links in here as well. So those will answer other questions you have. So that is all of our questions for this month. Thank you, Gary, for your time and answering them.
My pleasure.
All right. And keep sending those questions in and we will answer them. Thank you.
Absolutely.